Hello, everyone. Thank you so much for coming to our monthly webinar. My name is George Sardakis. I'm an associate here at Vincent Hirsch Financial Services. To my left, we have Vincent Hirsch, who's also a financial planner and one of the partners here at the firm. And to my right, we have Michael Hirsch, who is a financial advisor here and another one of the partners here at the firm. And today, we're going to talk about just some things that business owners should consider when they're going about their personal planning as well as planning for their business. To kind of start things off, I'm going to turn things over to Mike to kind of overview today's topic and kind of the breadth of how we work with business owners of different sizes and stages as it relates to not just their personal, but also their business.
Yeah, George, thanks for the introduction. The business planning is it's an exciting topic because it's always changing, and we found it because a lot of our planning clients are our personal financial planning clients are also business owners. And when we're doing a comprehensive financial plan, the business is a very important part of the success of that personal plan. So we integrated the business into the financial plan, and years ago, we started to integrate that just to business owners as an option instead of the comprehensive financial plan. We see a lot of different stages of businesses. We get clients that come in with startups. They're just new to creating a business, and all the way to maybe year 3 to 5, where now we're starting to make some money. We are starting to see rapid growth, and usually we see a little bit of an overwhelmed business owner at that point, where they're wearing a lot of hats. And then we move into that established business where they've been around for 5 to 10 plus years. They're making money, and we're making sure that we're being as tax efficient and making sure that we're creating a workforce that's loyal. All of these times, there's different areas that we like to focus and during these stages. So we're going to touch on a few of those topics, and how we can help to be successful during that time in that stage in the growth of the business.
Yeah, you'll see. Today we'll be covering a few of the main areas that come up when we're meeting with our clients regarding their businesses, common mistakes that are made, common areas of concern, and trying to help those of our clients, hopefully future clients, that have businesses come in and not make those same kind of mistakes, and hopefully provide some clarity on some of these areas that raise these questions. So with that, George, you want to start it off?
Sure. So we're essentially talking today about what business owners of different sizes and stages should be aware of. We're going to cover different entity structures, how to structure compensation, how to separate personal and business finances, how we go ahead and look at business retirement plans such as 401ks and SEP-IRAs, the importance of key person insurance and buy, sell, and succession planning. And then towards the later end of our business stages, how we plan for the transition of the business and the succession of it. And then kind of just 4 or 5 key takeaways that we can all walk away with by the end of today's presentation. So when we're talking about entity structure, there are a number of different structures that we could consider. We have a sole proprietorship, which is essentially just think of it like a freelance where you're getting paid to your personal social security number. The downside to that is that we have unlimited personal liability. So if, for instance, I have a 1099 job as a DJ and I set up my equipment, but for some reason my equipment falls and it breaks someone's foot, I'm personally liable for that under a sole proprietorship model. On the other hand, we have a single member or a multi-member LLC. Chris can get into the differences between the two of those, whereby the limited liability structure protects us on the personal side and the liability is essentially captured by the business. The consideration for that is through an LLC structure, you have to pay what's called self-employment tax on any profits that are retained in the business. And it's considered to be what's called a flow-through tax treatment. So if the business brings in X amount of dollars in revenues, and then at the end of the day, we bring in Y amount of profit, that Y number of profit is going to show up on our personal tax statement because the taxes flow through over to us. Do you want to kind of differentiate between a single member and a multi-member LLC?
Well, I mean, when it comes to multi-member companies versus single, when it comes to single, we're going to look at sole proprietorship, or you could do a single member LLC. When we have two or more, you're looking at either doing a partnership or a multi-member LLC. The difference really between sole proprietorship and partnerships, as George was indicating, is really just protection from claims that associate with your business. If I'm a sole proprietor or I'm a partner, very easy to set up, very straightforward. All of the revenue and as well as liability flows directly to my tax return and to me. If I have an entity such as an LLC or a C corporation set up, there is some corporate protection or corporate bail. Therefore, claims or anything regarding the business is going to that business entity which is registered with the state. Now, if we're going to get register an entity with the state, such as an LLC and a C corp, there is some additional work that's necessary as far as how you create and file and with the state and the different documents that need to be filed every year with regard to your business. Again, it's not overly burdensome, but it is necessary versus something such as a sole proprietorship or a partnership, which is extremely flexible and easy to set up.
Yeah, and to Chris's comments, with regards to business entities, this is something, regardless if you're a startup or you've been in business and you're profitable or you're established. This is something that we are looking at throughout that whole transition. It's not something that we set up and forget it. This is something that we want to continue to look at to make sure that we're creating the most tax efficient and the best option that you need at that time. I would say, it's much harder for an established company to change from, say, an LLC to a corp. So being proactive about this and doing it as soon as possible, making sure that we're in the right business entity and structure is definitely important. It'll create less headaches in the future.
And the three major questions we'll be asking is complexity of your business, need for liability protection, and ultimately looking at how you want to be taxed. Those three questions can help us answer what is the right form of ownership for you.
Thank you both. So towards the bottom half of the slides, we have two different corporation structures. We have S corp structure, which is essentially, it's very similar to an LLC or a partnership agreement whereby the taxes get flowed through over to the owners of the business. The key differential here, though, however, is you bypass self-employment tax because through an S corp structure, you're going to be essentially taking what's called a reasonable compensation and paying yourself a salary through the S corp. Again, the tax treatment is very similar compared to an LLC. Whereas a C corp, on the other hand, think of these as your large conglomerate corporations where those are taxed at the lowest corporate tax rate at 21%. And this is essentially where you have outside investors similar to those or actually exactly like those companies that we see listed on public exchanges all the time. The consideration here with regards to taxes is that you have what's called double taxation. So the company gets taxed at the corporate level, and then any dividends that are distributed by the corporation are taxed to those shareholders. So if you have 100 shareholders and each shareholder gets a $1 per quarter dividend, each of those shareholders are taxed on those $4 per share dividend that they're going to be receiving on an annual basis. And then they also have a more complicated tax treatment, which, they have those corporate accountants who are going to help them file.
And we will work with you and your tax professional to make these decisions for you.
So as it relates to owner compensation and any kind of payroll strategy that we consider with regards to the business, there are a number of different strategies that we could consider. We have a salary versus distribution as it relates to S corps, where owners will pay themselves what's deemed to be a reasonable salary and subject to payroll taxes. Again, this is a way for S corps to almost bypass the self-employment tax rule. You have your reasonable compensation rules, which the IRS essentially defines as a salary that would be reflective of that you would pay to a third party for the same job. So you don't want to necessarily set your salary too low or too high. That may be a red flag. And that's something that we would work with your CPA, or any financial professional would work with your CPA to kind of document.
Yeah, and this is important for the business owner, as that income through a W-2 can affect your future Social Security income, can affect how much you're able to defer into your retirement plan. So it's an important key topic there that, we don't want that W-2 or that income to be too low. At the same time, we don't need it to be as high as we might think. So, working with your accountant on this one is important.
We've mentioned this before, but with regards to self-employment taxes, this is a tax that's imposed upon sole proprietors and LLCs. This is a 15.3% self-employment tax on net business income. And once more, these S Corp or any kind of corporate election is going to help reduce or even bypass this self-employment tax entirely. Do you have anything to add with regards to any of these payroll structures? Obviously, it's different, Chris. Each business is going to have something that's more efficient for them. But
correct, efficiency is what we'd be looking at, and self-employment tax just means, as opposed to dividing the employee tax that would normally be paid, half of it paid by the employer, half of it being paid by the employee when they get their paycheck, you bear the entire 15.3% because you are both the business owner and the employee. So, but again, we look at this on a case-by-case basis. We consult with the tax professional and make sure the choice is appropriate for you. But again, something that's very important to look at.
Thank you. So moving right along, we're going to discuss the separation of personal and business finances. Now, this is one element that a lot of business owners may overlook, or they may be a little lax. Thank you so much on the separation of. So this matters a lot because it helps to protect the corporate veil, which Chris had mentioned earlier, whereby personal assets stay shielded from any kind of business liabilities. And that's important because if we have a claim against the business, but we have after-tax monies that's invested there rather than maybe shifted over to the personal ledger, those assets are then subject to any kind of claim or suit that may be imposed upon the business. To that end, also, when we refer to personal and business ledgers, we also extend that over to the P&L and cash flow reporting. making sure that any kind of items on the business ledger are reported as such to help to facilitate any kind of tax reporting and organization with our CPA. And it also helps to demonstrate a level of professionalism to show like, hey, we're making sure that we're extremely organized in separating our personal, maybe cable bill from our business office rent expense.
Your CPA is going to be very happy when you're more organized in this area. But also, we don't want to be leaving possible write-offs or deductions for the business. We want to make sure they're included, and we want to be as tax efficient as possible. So being organized in this area is very important. And again, it's going to create a happy account.
It also helps when we have a business that's growing and maybe has multiple arms. If we implement these organization and separation strategies early, it's going to help us keep everything siloed as such, and accordingly, maybe we have maybe run a cafe and they have a coffee brewing arm that's off-site, and they have costs that are associated with that arm, and then they have their in-house ordering and kind of customer service facing end, and that side stays separate. So making sure that those are siloed appropriately helps to really help the accountant identify which expenses are attributed to which arm of the business.
Yeah, I think this slide draws attention to something we find that's very important, and that's two things. One, accounting practices for business and personal are extremely important and must be set up appropriately. The second thing is business insurance. I could give you example after example about business owners that have come to us, and when we actually take a deep dive into their business, they don't have sufficient in business insurances, or they have not set up the appropriate accounting practices, which puts them as well as their business at possible harm in the future if there was any type of issue that comes up or any type of claim. So this is a very important slide.
Yeah, and one last thing with this slide, this during the business cycle and as we grow here, this is something, this is an area that the owner starts doing themselves. We're making sure that we're taking advantage and being as efficient as possible. As we start to talk to business owners that are now growing and they're making money and we're seeing this rapid growth in year 3 to 5, this is an area that we want to offload from the business owner. This is where we need to hire a bookkeeper to take that burden off the owner, because the owner, this is one of the first things we start to see is, okay, this is important, very important, but we may need an individual that just is going to focus on this area because we don't want it to get away from us.
Mike makes a really good point. Many business owners that are clients of ours kind of fit in many of these categories. They started out of their bedroom, starting a business, or out of their garage, and as a single person entity, and then grew to add another person, and now today they're a multiple person, very successful business. As you grow as a business and a business owner, we're trying to, these topics that we're referring to today become very important. Maybe day one when you start out, not as important, but certainly as we grow. And what we find is the business owners, however, with growing businesses, have more and more responsibilities trying to actually do the business. And that's why it's so important to be talking to a professional with regard to the things that we're discussing today, such as insurances, your accounting practices, and how you're setting up and running your business.
Yeah, those are all really good points, especially when we want to consider growth in the future. We want to make sure, our insurance is in place accurately and we're separating items appropriately, and, especially as we add new people, making sure that those are captured accurately. Now, one thing that we work a lot with business owners is making sure that we create sticky employees, loyal employees, and maybe we can even get a benefit for ourselves at the same time. And one of the ways that we do that is by implementing retirement plans. There are a number of different retirement plans we're going to talk today about. For the more common ones, we have a SEP-IRA, which is essentially a benefit to the employees whereby we contribute up to 25% of their compensation. These are typically easy to set up and administer. They have flexible annual contributions. It's usually to the discretion of the employer, as long as each of those are attributed the same percentage for all eligible employees. With regards to a simple IRA, we have employee deferrals that are capped at $17,000 for 2026. However, if we're over the age of 50, we have an additional $4,000 per year catch up. And then on top of that, if we're between the ages of 60 and 63, rather than a $4,000 catch up, we actually have an additional $5,250 catch up in lieu of the $4,000 if we're between 60 and 63. The other item here to note is that employers must match up to 3% or contribute of 2% flat contribution of the employee's contribution or salary, excuse me. These are also easy to set up. They tend to be a lot lower cost than 401ks. These are typically more appropriate for smaller businesses that don't necessarily want to pay the overhead to a 401k, and maybe they have like 2 or 3 employees, and this is just their way of saying thank you and creating a loyal employee base.
We see a lot of times startups or newer companies are going to start with these areas. They might start with a SEP-IRA and then graduate as they grow into a 401k. There's some great advantages to having a SEP-IRA where the business owner can really fund their retirement with a significant amount before we start to grow and add employees. So all of these have different positives and pros and cons. You know, the solo 401k and the defined benefits plan 401k, they're going to come with a third-party administrator that's going to need to file your forms to make sure you're IRS compliant. So there's some additional costs to them. Now, they're not tremendous in the way of costs. And there are some tax breaks that they are out there for the first 3 to 5 years of having these in place. But the SEP and the simple are a nice way to start. And you know, this comes back to George's comment about the sticky employee. You know, as we start to grow and now we're starting to make money, we have an established company, we turn our focus on making sure that employee is that we're building a loyal employee and someone that's not going to leave us because the guy down the street offers an additional $5,000. And by doing that, we're introducing the benefit package, right? So what, you know, okay, my salary is X, but what benefits are you offering me? So this is one of those important benefit packages that we like to introduce, you know, other ones along with, you know, health insurance and life insurance, things like that are gonna make sure that not only is that employee happy working for you, but they feel that they're part of the culture and the growing business.
In addition to that, again, we're finding that as planners, one of the most important things that, or one of the most important topics for people these days is retirement. And the best time to start thinking about retirement is when you're young and when you start a business, because you can find example after example that would show that the key to building a good retirement is time, allowing money to grow and compound over 10, 20, 30 years so that you have an adequate retirement. Today, it seems more and more that there are less resources for us in retirement. The pensions have gone away, and more of the responsibility is being placed on us to prepare ourselves for retirement which where we are seeing are getting longer and longer as people are living longer and longer. So this is a very important slide and very important topic for people to pay attention to.
Yeah, and I think just to kind of wrap this slide, we have the solo 401k, and then we have a defined contribution 401k plan. They each offer about up to a $72,000 contribution, and that's for employee and employer. If you're a employee over, or if you have an employee over 50, that contribution limit kicks up to about $80,000, and then again up to $83,250 if the employee is between 60 and 63. The owner in a 401k plan can participate as an employee as well, and they're also subject to the same plan limits. The solo 401k, the caveat to that is that you must have no W-2 employees other than your spouse. This creates more of an administrative complexity with regards to the plan as we move up at higher balances. And on the 401k side, the caveat to this is that once the plan assets exceed $250,000, that means the sum total of the balances within the plan across all participants over $250,000, there must be what's called a Form 5500 filed with the IRS. That's essentially states what, Chris?
The Form 5500 every year is going to give a description, comprehensive description of what went on in the plan that year, what employees are involved, the balances, and it's reporting that is federally required under ERISA.
So next we're going to talk about protecting the important people in the business. We do this typically through a key person insurance. You may have a CEO or a COO or someone who's critical in the operation back end of the business. This essentially will cover the life or disability of that person. That's going to those are premiums that are going to be paid by the business, and the business will also function as the beneficiary, whereby all the proceeds of that policy will go to the business, not the individual's estate. These typically may be founders or owners or top revenue producers, specialized staff, etc. These proceeds are typically used to help fund, I guess, the next project in finding this person during the transition. It's going to cover any revenue that may be lost as a result, or satisfy any other outstanding creditors who may have been impacted.
Yeah. And to George's point, I mean, this can be a huge disruption to your business if a key person passes away or becomes disabled, is unable to do their job. The key person insurance, as George noted, the beneficiary is the business. These premiums come out. They're not tax deductible, so you're paying those premiums after tax dollars, business. And but that allows the benefit to be tax free to the business, and there's really not that many limitations to what we can do. The business can do with the benefit. A lot of times that is used to, like George said, to train and bring on another support staff or someone to take over that position. But that's not necessarily just the limit to what it can do.
So next we're going to talk about kind of next steps for the business and the succession of the company. So what tends to happen, or what tends to trigger a buy-sell? Well, first, what is a buy-sell? A buy-sell is a legally binding contract that essentially will dictate what happens to a business owner's stake when they die or become incapacitated, maybe they divorce, retire, or any other kind of life-changing event.
Or they just want to leave.
Yeah, or they just want to leave. This helps to create a stable foundation for the business for any kind of unforeseen circumstance. So this could be things like death, like we mentioned, disability, divorce, leaving the company, any kind of bankruptcy or insolvency of the business.
Yeah, this document, should be created in the beginning stages of a business. However, we tend to see this become a topic. Once we have we're working with an established business. They've been, they're now starting to make money. That 3 to 5, sweet spot year. Okay, we need to put something in place. This outlines all the parameters, what to expect, so that everyone's on the same page. All the owners are on the same page. If someone's, God forbid, passes away, there's something in place, and this is how the next steps will go. But also, if we just have a separation, we have a business owner that no longer wants to be with us, this buy-sell agreement puts those procedures in place.
Yeah, I mean, this is as simple as we have members that are of like mind that come together and form a business and work real hard together and create a wonderful business. If something was to happen to one of those partners with their health, or they just decided they want to leave, the question is then, well, they own a share of the business. How's that person going to leave without disrupting? Would someone buy that share and step in? And maybe you don't want to be partners or associated with someone else. Buy-sell agreements allow for continuity. They allow partners to have the belief and knowing that if something ever happened to one of them, they don't have to end up with someone as a partner or in their business who they didn't hand select. Buy-sell agreements provide the money and the mechanism for someone to leave the business or to get through a unfortunate health issue with one of the partners without interrupting the 3 or 4 or 5 partners who started the business together. All right, and there's 3 different models that are set up there on the slide. It just really has to do with the way in which we would formulate them. These formulations are decided upon based upon the particular situation or circumstances in every business. There's something called a cross-purchase plan, which talks about the different partners would purchase a plan on one another to fund a buy-sell agreement. There's an entity purchase plan where the business is buying the insurance for each one of the partners. That would provide the money, the resources necessary if one of them was to leave or to die. And then there's a hybrid, which is a combination of the two. I don't think we need to dive deep into these at this point, other than to know why they're so important, and we find them to be highly important, and to know that you would work with your financial professional to decide on which formula would be perfect for you.
Thank you. So now we've moved past all of this, and now it's finally time for us to maybe retire, maybe get rid of the business, maybe someone's coming to us to purchase and buy us out. What do we do then? So this comes into the conversation of exit planning and business valuation. For many business owners, for the majority of them actually, the business represents their largest part of their net worth. This is usually represented in terms of their ownership stake, their investment in the business, etc. You have a couple of different ways that business owners can kind of leave the business. You can sell it to a third party. This is usually done to a strategic buyer, some kind of private equity firm, which is something that we've actually seen across many industries in the past couple of years. Or maybe it's even something where a competitor comes and they just want to take them over. This is typically the highest valuation, but it's also the most complex in terms of how it's sold. You have a management buyout whereby existing members of your leadership team will buy your shares out and essentially take over your share in the business. The business remains preserved and the other members of the business remain in place. It's more just a leadership transition than anything else. You have a family succession, which is typically done through family businesses where maybe the children or the grandchildren come into the business as dad or grandfather or mom or grandmother are leaving, and it's essentially a transfer over to a family member. This is done through complex estate planning, gifting, or any kind of different business continuity or interest planning.
The key here is right in the title. It's planning. We find way too often business owners don't have a plan. And not having a plan often can lead to disaster. We've seen time and time again, family businesses or smaller businesses end up being sold off or passed on to someone for a fraction of their cost, or a business owner dies and the family argues over what to do with the business, and ultimately what's done with it was certainly not the most effective solution for the family. So planning is essential. Understanding, do we have family members who want to come into the business and ultimately continue it on and run it? Is it something that they don't want to come into the business, and therefore we need to prepare in advance for the sale, or to bring in a third party or bot or someone to come into the business who will eventually buy out and run that business? Exit planning and business valuation, a very hot topic today, something that needs to be planned for.
Yeah, and this is usually a question that we ask our business owners, and they haven't really thought about it. It's something that should be talked about. This is, again, the exit strategy should start to be talked about well before the exit wants to happen, when we do want to exit. And so it's a plan for sure, and this is something that usually when we bring it up, it hasn't been thought about, but it's very important.
Yeah, and to Mike's point, you guys obviously have worked with a lot more business owners than I have, but what seems to be the common thread is that business owners tend not to think about this because they just spent so much time investing in the business, working for the business, meeting with all these different people, and focusing on the business's growth, that they never really put a lot of time, attention, or detail into what happens next. What is the next step or the next iteration of this business? I've been so in the weeds and in the mud about growing this thing. I haven't thought about, or to whom do I leave it? When do I want to sell, etc.
Yeah, that's exactly right. Good point, George.
And so now we're going to kind of take a step back and talk about, we went through this presentation. What are some next steps that you as a business owner can take? First thing you'd want to do is revisit your entity structure. Make sure that you meet with your CPA or your attorney to confirm your current structure. Make sure that it's still optimal for you to maintain as your income continues to grow. The next thing you'd want to look at is your owner's compensation, making sure that your salary is documented and defensible if you're structured as an S Corp. Make sure that you confirm your compensation levels align with what you're contributing to in your retirement plan, making sure that you're set up optimally for Social Security, even though for a lot of business owners that is a long, long time away. And we also want to make sure that we consult with your CPA to make sure that the model of your salary or your distribution is optimal for the current tax year, making sure that we're taking advantage of everything that we can. We want to establish or even review your retirement plan, make sure that we are taking advantage of the best type of plan possible. Maybe we're a 20-person operation and a simple IRA just, even though it's cost efficient, isn't necessarily the best bang for your buck anymore, and we may want to transition to a 401k plan. Or maybe it's something where we implement a profit sharing provision within our 401k plan that we didn't have 2 years ago. We want to compare different things, and we want to make sure that we are staying compliant with all of these different plans as well.
Yeah, and protected.
And we want to make sure we're protected.
Big part of this is, as we grow, we want to make sure our insurance is, and our business insurance, that's protecting the liability and our employees, and especially the owners, that it's being constantly looked at and updated, because we can easily outgrow the commercial insurance that we've had in place, and a lot of these things are constantly being looked at and updated as we grow the business and as we move forward.
If you're a business owner, we know 99.9% of all businesses in the United States are small businesses. 46% of all employees in the United States are employed by a small business. If you are a business owner, your personal finances and your personal planning is inseparable from your business. Therefore, business planning is extremely important. Making sure that we're integrating both our personal and our business plans is absolutely essential. We are doing business planning here for many of our clients who are both small business owners as well as individuals, and we'd love to do it for you. If you have any questions, please don't hesitate to give us a call.
Just some last thoughts, some takeaways. Here's basically our next steps as business owners. And with all of that, we want to thank you guys so much for attending. We know that sometimes these middle of the day webinars may be a little challenging to attend, so we really appreciate your time and your attention. And again, as Chris mentioned, if you guys have any questions, please don't hesitate to reach out. Thank you so much.
Thank you.